Hey everybody, it's Bob with Trade Genius. I got my good friend Phil here, and what we're going to talk about today is there is a 100% chance of recession, and we have the data that shows, and the data has hit. And you won't want to miss it. We're going to tell you what it is, and we're going to tell you why it is, and we're going to tell you what to do about it. So stay tuned.
Trade Genius.
Okay, Phil, I'm going to throw it to you because you found this chart. It's amazing. Usually when you're trading and or trying to make some macro predictions, me being in business development in my prior life and now trading is that if you can be 2/3 or better, those are high odds for making bets. And we're finding data points now that are basically back testing at 100%.
Right.
And I want to throw it to you if you want to share people what this chart is.
Yeah, so let's slide right over into this chart. I don't think this is a chart we've ever shared on the channel, but this is a percent of civilian labor force that's been unemployed for 15 weeks or more. And you can see that with every recession going back to the 1950s, this has spiked up. So, the level that we're at right now is concerning, but the thing that really sets it off and really triggers a recession is the rate of change off the bottom. And we're starting to get that typical bottoming effect there and quick move up from that. So I think that we're just, maybe 1 month, maybe 2 months out from when they actually put the stamp on it and say we entered recession, because they're not going to announce that or confirm it probably another 3 to 6 months after that. So I'm saying that within the next couple of months, though, they'll probably be looking back saying that we technically entered into recession, because the hit rate on this, especially over the decades, and this covers a multitude of different environments, inflationary, stagflationary, you name it. And this is the one thing that really has a very, very high hit rate, undefeated really. So anyway, 15-week unemployment, we haven't shared that. We thought we'd bring that to you guys' attention. The next one we wanted to look at was also affecting the job market and ultimately the consumers, right? Because if nobody's working, then consumption comes down. What kind of economy do we have in America? We have a consumer economy. So this is why this stuff really matters, and why these, especially when it comes to unemployment numbers having a 100% hit rate with recessions, this is important stuff. This is the unemployment level permanent job losers. Notice we're spiking here, right? We're going back over that zero line. These spikes precede recessions, the last 3 here on the chart, and we're going into what appears to be a 4th one. So permanent job losses spiking really quickly here. And then we go to another consumer chart, which is essentially the household net worth. So if we look at the household net worth, notice what's happening here, contracting for the 4th time. Again, extremely good hit rate when we start dipping under 0%. Sometimes we get recessions and we don't hit the 0% line. And now here we are at the 0 line. This is a percent change from a year ago. We're going into negative territory. Extremely recessionary print here. And again, I think these numbers, we can look at macro data. We will look at a macro slide here in a second that goes along with this. But I think if you're just concentrating on the driver of this economy, which is the consumer, you got to be super concerned here. This is not a place that you want to be going in long with long-term investing. And especially, it's a weird market because we have tech that's in a bubble, but we have things like long blue chip plays like Disney, and of course they have their issues, but they're at multi-decade or a decade low here. And you're thinking, well, I could dip buy it because ultimately they're going to rebound and get their house in order. But no, they could go much lower. This is not the time to put any money to work. I don't care what the drawdown is in some of these stocks. We have a big dislocation and things are going to get probably much cheaper. And this tech, it's just a weird market. We've never had really a tech bubble and then another segment, other segments going down the toilet already, which I think is a leading indicator for what's coming for tech. And we've shown you guys how tech underperforms. This is a time to be getting into energy and yada, yada, yada. So this is the consumer, guys. You've seen these 3 charts here, very recessionary. The last thing, and then I'm going to throw it back to Bob. If you guys notice here, this is more of a macro fundamental chart here. This is the earnings yield of the S&P 500. So if you take the average earnings yield, and it's under the cash yield as measured by the 3-month T-bill. So that shouldn't be negative in terms of that, but it is. So you're actually, cash is, when the earnings yield in the S&P 500, which is why these valuations are as high as they are, when that's fallen under what your cash can yield, it's time to leave the market. It's historically led to big equity sell-offs, and that's where we're actually at a very negative level here, because you'll notice in the great financial crisis in 07, 08, 09, we didn't even go negative in this regard. We're negative now. So this is more along the lines of what I've been saying, which I think we're more following along the dot-com bubble bust, and we're starting to get into that territory there, Bob.
Yeah. I mean, look, it's funny. Everybody is throwing seasonals at you and telling you this, that, and the other thing. But, all the other seasonals are working too. So we're now sliding into what they call the late stage. And the late stage is where the Federal Reserve is now crimping the ability to use leverage to drive asset valuations. At the same time, we have people who own commodities now have woken up to the fact that basically the Western powers had been shortchanging them. And now we're getting geopolitical pushback around the world. And, especially in the energy space, looking at uranium, Phil, and you're looking at, energy with Russia and with Saudi Arabia. You're looking at cobalt in the Congo region, and it's starting to all add up. And what they're doing, which is, from their standpoint is kind of savvy because there's so much leverage in the system, is that, they have people that have PhDs in math too. And they're like saying, hey, if we could crimp production by X percentage.
Hey guys, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
We can drive Y to a higher percentage than we're losing in production. And that's exactly what's happening. And so as energy costs go up and food prices go up, and food prices are going to go up because of the El Nino effect. Basically, Australia is offline for wheat this year because they go into massive droughts, and then you have massive flooding in other parts of the world that basically are going to crimp it. And then you got Russia basically taking the marginal production Ukraine has off the market. And so the Federal Reserve is now stuck in an environment where they're trying to delete demand through restrictive monetary policy, but we have supply shocks. So it's the worst possible world. Bottom line is the consumer is now dead. And look, there's a lot of people I know, especially in their 50s, that are getting blown out of jobs right now that don't have a cushion. Some of these guys don't even have a house. They're renting, and they can't qualify yet for Social Security and Medicaid. And you have no choice but to absolutely just hunker down. And we're starting to see it, Phil. I mean, and I'll throw it back to you on Hawaii, but even here in California, I was just remarking to my wife, it's like basically, we saw one thing hit with Easter, when you get that big slowdown. And then over the last 3 weeks, again, everywhere we go, I'm like, why is it so empty? I'm talking about Trader Joe's, I'm talking about restaurants, I'm talking about Home Depot. You don't see that same energy level that you've seen in the past. And I'm just wondering, I told my wife, I said, it's not going to be an event. It's basically people just like slowly falling off the edge, and it's just going to be a cumulative effect.
Yep, it's the same thing. You're starting to see the slowdown. Housing market is very sticky because there's a lack of inventory on this island anyway. But you're starting to now see foreclosures, which we did not see for the last 2-3 years at all. Now all of a sudden, you can look online and there's like 10 foreclosures on various parts of the island. So I agree with you. I don't think this is going to be a sharp drop off. It's a highly anticipated recession, right? More so than I think the last two. So maybe what we're going to get is it's just the effects of it are just going to be like the long kiss goodbye, correct? It's slowly going to happen. And instead of I think like the great financial crisis, .com boom was rather sudden. I think this one might play out over time, especially in things like housing, because you have people locked in really good rates. So again, I think this is going to be a little bit different because we had such a massive amount of liquidity injected into the system from the money printing and the stimulus stuff that we don't really have a comparison historically for that in recent times. So I think this is going to play out a little different than the most recent recessions. I think it will end up being a recession. Hopefully it's not a 2-year long recession. I just think that the way we're going to get into it is going to be different than the last 2 times.
Yeah, and and the thing is too is my view is we're in a recession because but you're talking straight up activity. But yeah, I agree with you. But look, we have a situation now where we have basically the baby boomers are rolling off. They're not going to be adding to GDP, and they're just going to spend what they have until they spend themselves off. So they're not generating household formations and things like that. You're seeing a backlash on Airbnb. You're seeing the car market starting to implode, and like I said, housing is there's only housing activity you have is people who have to move and have to buy. Yep. And so all these things are just adding up. And if you guys know too, is I think his name is Sam Harwell, the lead singer for Smash Mouth. You remember that song? This is what the recession is going to look like. Okay?
Yeah.
And I didn't think the devil sign, Phil. I just couldn't get my pinky down.
Oh, I actually think too that's the shape of the next Bitcoin wave, right? We've had these nice symmetrical waves around the halving event, and that's something that we'll probably cover next week because I know we haven't really touched on Bitcoin specifically for a while. But I think this is also going to affect Bitcoin. And we're gonna get into the reasons why the halving date may not be the pivot point that it has been in the past, because these macro forces matter more to Bitcoin than the halvings. We're gonna talk about that next week. So for you crypto guys, look out for that.
Yeah, really. One last thing, if you don't mind, Phil. So people always ask, well, what are you going to do after energy? Is that I think you literally got to slide from energy into the long bond. Okay. Yeah. And that's my plan. I'm fully invested now in TLT. I still got all my energy names. And the only thing at the end of this cycle, the only thing I'm going to be keeping is my ExxonMobil, because it's at this point, it's a family heirloom, and I'll just be hedging and collaring around it, but definitely start moving into the long bond. The Fed has no choice. They may talk a big game, but they have no choice. This whole thing's just going to implode around them. And we'll talk more about that next week. So anyway, thanks, Phil. Sorry to cut you off.
Oh no, and I think that's the right play, because that is what happens in recessions. And if you guys are looking for confirmation, I would look for where TLT is up on the week and the S&P 500 is down on the week. And I think then you start looking at that divergence, because that's exactly what happens. They diverge, and then you buckle up, because the final blow off in terms of the recession, or should we say blow down, because you're going to have a pretty good waterfall sweep in everything, risk off assets, and then that's going to be it. And then you got to get position long. So the timing on that's really important. Stick with us, because we're going to get you positioned for that scenario. All right, guys. Well, that's going to do it for this video. Thanks for watching. Please hit like and subscribe. Again, check out our specials over at tradegenius.co. We'd love to see you guys in the room. And if you could smash that notification bell and set it to all, that really helps out the channel. We'll see you guys on the next video. Take care.
Trade Genius.